You've heard the saying, marry the home and date the interest rate. What does that mean? It means that you should purchase the home today based on where current interest rates are. And when interest rates come back down, you can always choose to refinance. So, what does refinancing mean? And why are you hearing this from lenders telling you that purchase the home today with the current interest rates that you have right now in the marketplace, and when inflation comes down, you will start seeing interest rates coming down, and that's your opportunity to refinance. So, refinancing means that you already own the home and you're reducing the interest rate or changing the term of your loan or getting rid of PMI and taking advantage of a new loan at a lower interest rate or a lower monthly payment. Now, refinance can be one of so many things. It can be where you're reducing your interest rate. It could be when you're getting rid of PMI, when you wish to combine all your debts into one and do a debt consolidation refinance, or if you built equity in the home and you wish to do a cash out refinance. How do you determine when is the right time to refinance? Let's take the most simplest explanation right now. So, interest rates right now are where they are because of inflation. We've seen inflation historically has been in the 2% range. Because inflation moved up so fast and rapidly to the 9%, you saw the Fed raising rates quite rapidly. As a result, you see mortgage rates now are in the high sevens. Well, those interest rates are bound to come down when you see inflation coming down. That's why the first opportunity to refinance is when you see inflation coming down. Our anticipation is when you see inflation coming down and you see the Fed holding tights on interest rates and not raising rates any further, you will start seeing that interest rates will start to trend down. Should you refinance as soon as interest rates come down? You probably need to have a more detailed calculation than just jumping and doing a refinance the minute you see interest rates coming down. The way you determine what's the right time to refinance is to calculate what the break even means. That means the cost, there is a cost to refinance. It is typically a fraction of the cost you would incur when you purchase a home. So when you calculate a break even, you see what the savings are from the drop in your interest rate or the removal of PMI, and how quickly would you be able to be cash flow neutral for incurring those closing costs. So, for example, if your closing costs are about $3,600 that you would incur to refinance, and your savings on a monthly basis is $300, you $300 per month, you probably would recoup the cost of the refinance in under 12 months. Would that be beneficial to refinance at that point? Yes, it would, because at that point, keeping everything equal, in 1 year's time, you would have paid for the cost of refinancing, and every year thereafter, your mortgage payments will be lower. So, what are the costs of refinancing? What the cost of refinancing would be a reissue of title, your typical lender fees, such as processing, underwriting, or application fees, the appraisal fee, the credit report fee, recording charges, and what you would pay to the title company to represent you for settlement or closing. If you're in a state that you have additional closing costs, such as Florida, you have your taxes, you need to determine what the total taxes are to see what the break even for that refinance will be. If you're refinancing a condo in New York City, or you're choosing to refinance a single family home in New York and you paid a mortgage tax, you will not need to reincur that mortgage tax because we could do a SEMA refinance and transfer the tax from the original loan to the new loan. The good thing about refinancing, in states where you have a mansion tax, you do not need to pay for that mansion tax again. Also, in a lot of states where you are refinancing, you do not need to incur or pay attorney fees again because the title company can represent you for closing. There are so many ways to calculate the break even on a refinance. We can go over what my anticipation of when interest rates will come down, or what my gauge will be for when you start seeing interest rates coming down. And we can go over the benefits of refinancing sooner versus later and what the anticipated closing costs look like for each year of your specific states. DM me or call me on my cell 201 745 3426. Shaleen Mahtani, and have a great day.